right, good morning. This presentation is based on the research conducted by Rusty Dame, a graduate student there at the University of Florida. This was part of his master's thesis. I also want to recognize his advisory committee, Chuck Adams, Kelly Grogan, in the Food and Resource Economics Department. Rusty should be giving this presentation, but he's pursuing his PhD now at Oregon State, a sharp young fellow. All right, like all agriculture and other aquaculture industries, there is risk in off-bottom oyster culture. So normal risk is related to those occurrences that can typically happen during production, such as inclement weather, predation, fouling. So if you've got your business plan where you're going to have 100% survival, you're not taking into effect typical risk, and those mortality and costs are generally considered acceptable at a certain level. So what we did in a project that incorporated applied research and demonstration, we looked at a financial risk assessment, looking at the more atypical or abnormal environmental and economic risks, and evaluated their effects on oyster production and the farm profitability. So the risk assessment evaluated the effects of these risks over a 5-year period, 2018 to 22. You really can't project beyond 5 years as the uncertainties just get too great. Risks are certainly site-specific, so we looked at 4 west coast counties in Florida that grow oysters, from Levy County, WAKULLA, Franklin, and ESCAMBIA in the Panhandle. Environmental and economic risks include hurricanes, tropical storms, high and low salinity, sustained salinity events, as well as market prices. So to do a financial risk, we have to have a basic understanding of the cost and earnings of a farm. So we're able to use information conducted from our growers and UF field trials conducted as part of this project from 2015 to 2017, in which we distributed 5,000 triploid and diploid oyster seed to 8 farmers in 4 counties for 2 growing seasons. UF also grew a similar amount at the experimental lease off Cedar Key. We also used that to document through replicated trials various management strategies, and we presented all this information at last year's Oyster South Symposium. So what we're able to do is document growth, survival, fouling, other parameters for multiple growing areas using various gear types for 2 ploidy types and 2 growing seasons. And that information allowed us to develop assumptions for a small-scale farm budget model. We also distributed logbooks to the participating growers in which they documented their labor for each culture activity. We interviewed several growers in depth to get additional farm background information, as well as capital and operating costs, and to estimate the effects of these risks on their production. So all of this was then used to generate a hypothetical small-scale farm budget for oyster culture on the west coast of Florida. Here's some of the production assumptions. Again, a 5-year planning horizon. All right, so we started with 10,000 seeds, so that's how we started our new farm, with 10,000. I said hypothetical, maybe not realistic, but by year 5 we were up to 250,000 seed. This is what we used for our assumptions. Planting seed size, 6 millimeters, that required 3 bag sizes. Again, based on growers' input, we used an average survival of 80% per crop, and of which 90% were marketable of those oysters. Financial assumptions: seed cost $25, average growing unit cost of $33. That was based on a floating bag system. We even, again, since this was a new farm, we amortized boat and motor costs, as you see there. Part-time labor not coming into effect to year 4 at $12 an hour wage. For Franklin and Levy County, since those lease areas or growing areas also are suitable for clams, and many of our growers also can grow clams there, we used a partial budgeting for startup costs pertaining to the lease and for boat and motor fuel costs. The output of this model was that it was the net returns to the owner-operator prior to taxes. So we were able to access long-term databases from federal and state agencies for our environmental risk assessment. For hurricanes and storms, we were able to use the database from NOAA for hurricanes going all the way back to 1900. For our salinity values, our Florida Department of Agriculture and Consumer Services, they monitor our shellfish harvesting waters, and they have monitoring stations that they've been looking at collecting data, monthly data, since the 1980s. Now, we don't have any historical oyster prices for cultured oysters in Florida, so we're able to use those prices for Virginia cultured oysters collected by Virginia Institute of Marine Sciences from 2005 through 16 as a proxy. So all of this data then was incorporated into a risk assessment model. And let's look at these risks a little bit more in depth. For hurricanes and tropical storms, we only use those events that happened to occur during the study period of 15 through 17, and there were 3 of those events. So we use those characteristics in terms of speed, wind speed, direction, and then mined the NOAA database to come up with probabilities for those type of storms affecting any one of these counties. We could have added other storm events, but we didn't, and we certainly can now add the real effects of Hurricane Michael that just happened 4 months ago. That will make this assessment more realistic as you put in more information. Effects from these type of events obviously increase mortalities, labor, repairs, operational capital costs. You see that obviously these effects or risk vary by county. Levy County and Franklin County having a probability of 19% for one storm affecting in a year. That coastline, and decreasing as you went from WAKULLA to ESCAMBIA County. We also looked at the probability of 2 storms in a year, and see for WAKULLA County that was up to 4%. Looking at the environmental risk of low salinity, and we considered that to be a sustained period of less than 10 parts per thousand for 2 or more consecutive months. Similar effects in terms of cost to the operator. Again, it varies among counties. You see for Levy County West a 4%, 11% probability for WAKULLA County. Our highest probability for ESCAMBIA County at 50%. We did have a low salinity event during the study period. High salinity considered sustained greater than 35 parts per thousand over 2 or more consecutive months as a result of a severe drought. Again, similar effects as low salinity risk, again varying by county, with most of the counties having 0%, and Franklin County, because those leases are located in a harbor with very little freshwater inflow, at 30% probability. So in fact, if you look at a distribution of salinity, and this is one of the lease areas off Levy County where we have a continuous water quality monitoring station, that gives you an idea of the distribution, where the majority of the average of that salinity at that site is around 25 parts per thousand, but the red area there represents those risks of where you might have a low salinity event below 10 parts per thousand or greater than 35 parts per thousand. 5 minutes? Okay. Economic risk. Market price, you see where we projected that from 2018 to 22, and the average projected price increased by year. The variance also was considered each year, but did not vary among counties. And let's look at how we obtain that information. Again, looking at the VIMS data, the red dots are the observed values over that time frame. The black line is the linear regression that allowed us to predict beyond 2016. The shaded area is the variation, because you see the red dots don't meet that line, so that's the variation or the variance that created this distribution here, looking at just the 2018 market price, where you have an average of 43 cents, but you can see that from the distribution you could have lower than 39 cents or greater than 50 cents. Simulation, since I'm running out of time, let me just say that there are risk forecasting tools out there. We used a Microsoft Excel add-on, Scimitar, to use this. It creates random sampling, multiple simulations, in this case over 1,000 times per county. The outcome of that is it provides a distribution of profitability estimates for each county on an annual basis, and I want to get to those graphs right now. So this is a fan graph, and what you're looking at on the left-hand side, the y-axis, is the expected net income over a 5-year period there looking at a negative $10,000 up to $90,000. The black line represents the average expected value of 50%. And for this county, that's estimated, assessed at $62,000 net return to the owner operator prior to taxes. A 50% range is depicted by both the green and blue probability percentile levels, and so you have a range of 70,000 to 56,000, but you also have a probability of earning at a 5% level, earning greater than $78,000 or less than $35,000. You also note this is over a 5-year period. This was a startup farm, so you see in year 1, you're obviously going to have negative net income results. So let's move on to the other counties real quick. This is Franklin County. You had a higher combined risk. I think Levy County was 23%. Now we're at 51%, so you're going to see a greater variation in these probability levels. $57,000 at an average expected net return. Here's your 50% range, 60 to 80, 68 to 50,000. And again, at 5% risk, you can make 78% probability, not risk, or as low as 26,000 or below. Both of these counties use partial budgeting because of the clam operations, so you'll see a little bit of difference with WAKULLA County here. The combined risks are less than Franklin County, but you see a similar outcome here, $57,000 expected average net income after year 5. Here's the 50% range, and there's the 5% probabilities there. The higher combined risk were for ESCAMBIA County, so you're going to see a little bit difference in the fan graph here, as well as projected average and the various probability levels there. You note at that 5% level, you also see that you might have a negative net return even up through year 3. Quick summary, so environmental risks do vary among counties based on probabilities. In this case, as more oysters were cultured, net returns increased, but risk also increased. There's almost a 100% chance in this assessment that all farms become profitable at the end of the 5-year startup. I need 1 more minute. So let's make this more practical. Let's take this information and apply it to you. So we created, using these findings, we created an oyster farm calculator. It's just an Excel spreadsheet. Allows growers to enter your own cost and production to generate your farm's financial risk situation. It can be downloaded at this website. So you're allowed to enter your own farm inputs. Again, this is based on these 4 counties in Florida. You calculate that, and you come up with a farm income statement showing your total fixed and variable costs, additional costs associated with these risks for your county. You end up with total farm costs then. You have plantings and mortalities, normal, and those associated with the risk affecting your county. You come up with the number of marketable oysters. You put in your revenue based on the price you expect, and you come up with your profitability associated with those risks. The outputs of that are the fan graph that you just saw, as well as a risk stoplight chart. So this allows you as a grower to put in a lower amount that you were willing to accept in terms of your net income, as well as a higher amount. So that spits out then these stoplight charts. So at year 1 and 2, and I put the data in again as a startup farm, you have 0% chance of earning between that range. You're going to earn probably less than $50,000 because you're just starting up and you're not planting as much. By year 3, that yellow depicts that you have a 92% chance that you're going to run between $50,000 and $100,000 as your net income. By year 4 and 5, you have an 88% and then a 100% chance of exceeding your upper limit of $100,000. So I think that's it, Bill.
Thank you, Leslie.